Well, good day and good afternoon, and welcome to this masterclass on the end of financial year / start of financial year here at Finder. Good morning if you happen to be in somewhere other than the eastern seaboard of Australia, of course, anywhere around the world, live on YouTube or Facebook. My name's Tim Bennett, and I'm very happy to be here. I'll introduce the rest of our panel in just a moment. But first, I want to begin today by acknowledging the traditional custodians of the land on which we all meet today, and to pay my respects to their elders, past, present, and emerging. Our panelists are joining us from the lands of the Gubbi Gubbi, the Yugambeh, and the Awabakal people. I'm speaking to you from the lands of the Gadigal people of the Eora Nation. I also extend this respect to any Aboriginal or Torres Strait Islander peoples joining us today. That may include you, of course. I'm your host, Tim Bennett. I'm the insurance publisher here at Finder and co-host of Finder's Block Climbing podcast. But enough about me, let's talk about our guests. I want to start by introducing our special guest to this masterclass, Nicole Pedersen-McKinnon. She's an independent financial expert. You would have seen her work, her words on the Sydney Morning Herald, in The Age, the Canberra Times, as well as on telly, the ABC, Sunrise, Studio 10 and more. She's also the author of How to Get Mortgage Free Like Me, which was the finalist for Best Personal Finance Book in the country for 2020. Nicole, thank you for joining us.
Hey, Tim, thanks for having me.
We've also got a couple of Finder experts on the line here. We've got Sarah Megginson. She's the head of editorial at Finder, a prolific finance writer and editor, including over 25 best-selling non-fiction books that she's worked on, as well as work with some of the biggest mastheads and brands in the country. Sarah, great to have you here.
Thank you for having me. Very excited to be here.
And Alison Banney, another prolific writer and money editor here at Finder. Alison has spent the last 10 years or more writing about finance, both for Finder as well as for some of Australia's best mastheads, including Yahoo Finance, Money Magazine, and Dynamic Business. Alison, hello.
Hi, how are you? Great to be here.
Very well. Okay, so the reason we're having this conversation is because it's, look, honestly, been a tough year. You know, it started off, of course, the back of the COVID-19 pandemic, which was financially and personally very interrupting for a lot of us and very disruptive. Of course, the war in Ukraine was not a great way to start 2022. And it led to, among other things, inflation, turbulence in the crypto markets, as well as the general downturn that we've seen across the globe in our financial markets. It is more important than ever, as a result, to understand your money, make it work a little bit harder for you, and to save money where you can. Now, of course, that's not just by cutting back on avocado and coffee and doing without. It's also about being smart, comparing your options, and trying to save money where you can. And that's, you know, essentially what Finder is all about. I mean, one of our team just today pulled together a couple of potential savings that you can make. Take car insurance. You know, you can save $250 potentially just for 20 minutes worth of comparison. And there are a few different versions of that, but like that's what we try and do here at finder.com.au, is to try and make that a little bit more accessible for you. Now, we are talking the talk, but we're also walking the walk today. And so we'll be picking 5 of our favorite comments or questions during today's masterclass, and we're going to be giving them each $20 of Finder wallet credit. So if you'd like to pop your questions in, we would love to hear them. We will try and answer as many as we can at the end of this call. If you'd like to ask a question, head over to the Facebook live feed and add a comment there. You can find our Facebook page just by searching Finder AU on Facebook, and the live stream will be there. If you are streaming on Facebook, you don't have to do anything. If you happen to be streaming on YouTube or watching this later, then, well, if you're watching it later, then I can't help you. But if you're watching it live on YouTube, then jump over to Facebook, pop a question in there, and as well as hopefully just contributing to the discussion, you may be one of those lucky winners. A quick disclaimer before we get into the actual meat of the thing. Nothing in today's session is personal financial advice. It is general in nature, any of the information that we talk about today. You should always seek your own professional advice that takes into account your personal circumstances before making any financial decisions. Now, questions that you submit on the Facebook chat will also be subject to this as well. So please keep in mind that we're doing our best to keep you educated and up to date, but we can't provide personal advice on your specific situation today. All right, let's get stuck into it. It's the start of a new financial year, and that always means changes, but this year is especially turbulent. And I want to just start off by talking in general with our special guest today, Nicole Pedersen-McKinnon. Welcome to the happy financial new year, by the way, Nicole.
Hey, happy new year. It's my favorite time apart from budget.
I can imagine it would be a busy one for you. So why don't you start us off? Give us a bit of an overview. What's the new financial year look like this year, as well as generally speaking? What should we be looking out for?
Oh, look, even in the run up to the clock ticking midnight, right on June 30, stuff had changed quite dramatically for most households around the country. We've got this, Putin petrol spike and then inflation on everything from power to petrol to petite leaves. And then on top of that, inflation spikes mean interest rate hikes. So we've been now dealing with 3 months of them, taking the official rate to 1.35%, but that's nothing on the unofficial or the mortgage rate. So the variable is now within days going to be about 4.65% on average. Now, we know average is not the best and there's a lot of wiggle room in there. And if I can just jump ahead and spoiler alert, the one lever to pull if you've got, if you're at a time poor is that mortgage and a refinance. But anyway, we'll talk to that along the way. Then you've got talk, of course, because the whole idea of these interest rate rises is to slam the brakes on the economy, get that inflation rate down from 5.1% to within the RBA's target band of 2 to 3%. Because there is talk that it's headed to 7%. They just can't have that, right? So it's a blunt instrument, but that's why we've got these very sudden, quite scary interest rate hikes. So that's, of course, feeding directly into the property market, which makes us all feel, it's that wealth effect. It really does make us all feel very poor. But another caveat on this one, I would say that, your property is only on paper. Its value means nothing unless you have to sell it. So if you can cover those repayments, just ignore the talk, ignore those headlines about property price falls because it matters to you not. So we'll unpack a lot of that, I'm sure, in this session as we go through.
Nicole, thank you so much. Now, we will come back to you repeatedly throughout this session.
For sure.
What I want to do, though, is I want to maybe start, let's just start with tax, because, of course, the start of the new financial year means that everyone stresses out about doing their tax. And I know, for one, I'm very bad at it, and I do a terrible job of actually going through the deductions that I'm able to be, that I'm eligible for. So, Sarah, why don't we just begin with talking about, I think one of the big changes this year are the working from home deductions.
Yes.
Tell us a bit more about them and what we can claim.
Yes. So starting this whole conversation off with a big general disclaimer that we are not accountants and you should get your own taxation advice. Have to throw that out there, but we're going to do our best to give you some information you can actually work with here. I think one of the biggest questions that we get is for people, particularly through COVID when we've been working from home, is how to maximize your tax deductions. And this financial year that we've just had is the last chance we've got to use the government's 80 cent per hour rule, which a lot of people have heard about. And that allows you to claim 80 cents per hour for the time that you are working from home. So if you're working 40 hours a week from home, and you can, kind of provide evidence to the tax office of that if you need to. That's one of the key things here. It's not just kind of like a free-for-all, anyone can use this. You really do have to genuinely be working from home and have a home office kind of set up to claim this. It's 80 cents per hour. So across, if you work, 40, 50 hours a week across the full financial year, it works out to be about a $1,600 deduction, which is pretty massive. As I said, it's not everyone is eligible for it. And you have to keep decent records. So I think the tax office wants to see a 4-week example that you can kind of can pull out there. But it also means you can't claim, it's kind of a catch-all. It means you can't claim other things separately. It's a really easy way to do it. It's kind of like a fast-track way to claim your tax deductions, but you then can't claim things like a mobile phone or internet usage and things separately. You can't double dip is the main.
So just to confirm, you can either detail your expenses from working from home specifically or do this sort of shortcut. It's one or the other.
Exactly. That's a great way to put it. So you can either go through all of your bills and work out, the portion of internet you used for working from home, the portion of your mobile phone that you might have used. You can work all of that out separately, or you can use this shortcut method, this 80 cent per hour rule. It's been available from March 2020 when the pandemic was first kind of announced through to June 2020. So across that period, you're able to use it. As of the 1st of July this year, it's one of a number of things that is changing as of the new financial year. So you're no longer eligible to use it as of this month. However, the tax office does have other strategies you can use, and there's other deductions you can use. So we'll get into that a bit later. But that's one of the most straightforward ways to go about it this year. If you do have a home office based setup, it's a great way to claim deductions.
Now, one of the things I know that I've considered myself is whether or not I should get help when it comes to figuring out what deductions I'm eligible for, because of course it's not just working from home, there are potentially other deductions you can make. What's your perspective on whether doing it yourself or getting, a tax accountant on the books and actually paying for someone to help you out with? What's your position on that?
Yes, a great question. And the funny thing in Australia is we are one of the most tax accountant using people in the world. So we often use accountants to pull our tax together. In other countries, they're not as prone to do that. So I think it's definitely a personal question. One thing that I would say is that ATO now makes it really, really easy to do it yourself. They use a lot of autofills, they pull a lot of information. So if you give them the permission to do that, they will pull data in from your employer. So all of your income and your tax that you've paid will be pulled straight in, your bank interest that you've paid, because any income you've earned and any interest that you've earned, you have to pay tax on. So they can talk to your banks and pull all that data in. So it is quite a straightforward way to do it yourself. My caveat there would be anyone who thinks they're not very good with numbers, or they're not really sure where to start, or it kind of confuses them and they think it's going to sit in their too hard basket for too long, then it's worth paying to get the advice, because there are so many different things that you might be able to claim. Things like charity deductions that people don't necessarily think about. They're all tax deductible as long as it's a registered charity. There's lots of different working from home deductions aside from the ones we were just talking about, depending on your specific work. If you've done any training or any studying, that might be deductible. So I think it's definitely a personal decision, but I think for people who are not sure, maybe start the process, get online and log in and see what it's like, because I think once you look at the actual setup of it, it's really straightforward. Every year it gets a little bit easier. It's quite a streamlined process to do your tax yourself. So if you're confident that you've got all the info you need and you can pull it together, it's pretty straightforward to do it yourself. I think anyone that has a more complex situation beyond a salary and wage earner, if you've invested, if you hold crypto, if you have an investment property, if you have shares, any of those types of things, and it gets a bit more complicated, then it starts to be worth paying for advice.
Yeah, I can imagine that people, retail investors in crypto markets especially, is going to spike the number of people that use tax accountants in this year probably, but then coming years as well.
Could I just jump in there at all,
please,
Tim, if I may, and just agree exactly with what Sarah said. Just also be wary about doing your tax too early. So the ATO has put out a warning in the past week, just saying that pre-fill, which is amazing, it'll take a while. So don't go and put your tax in next week, because you might find that you're missing out on deductions. So just, give it a couple of weeks before you actually do file, if you're doing it yourself.
I know I use a robo-investor to mostly just invest in index funds or exchange-traded funds, and they don't file their autofill information until midway through August. And I think that's because a lot of their clearances don't happen till the end of July.
Yeah, there you go. So in specific situations, you may really have to just be patient, if you're hoping for a refund.
Yeah.
Another good thing to note with using a tax agent is that you can claim it on tax. So the cost of going to a tax agent is tax deductible.
Yeah.
Well, Alison, let's maybe pivot a little, and we can come back to tax because I'm sure there are plenty of questions about it when we get to the end of this session. But Alison Banney, as our money editor, you talk about superannuation quite a lot. And there are some, for the first time in a little while, some big changes to superannuation that start this year. Can you just give us a rundown of what those changes are?
Yes, definitely. So some changes that affect pretty much everyone that has super this year is that the super guarantee rate has increased. So last year, the super guarantee rate was 10%. This year, it's gone up to 10.5%. And that rate's going to gradually increase by 0.5% until it reaches 12% in 2025. So this is the rate of super that your employer is required to pay you on your annual earnings. So the fact that it's going up is great news for employees, because it means we're getting paid more super. So how it works is it's a percentage of your annual earnings. So say you have a salary of $100,000. Last year, with the super guarantee rate of 10%, you would have earned 10K in super from your employer. This year, same salary, 100K, but you'll earn $10,500 from your employer. So it means you're getting a bit more in super every year until 2025, when it hits 12%. Now, you might think, $500 extra in super, that's nothing to sing and dance about. But over the space of your working life, you could have 20, 30, 40 years left to have your super invested. That $500 extra is going to benefit from compound growth, continue to grow and be worth a lot more than that by the time you retire. So it's really good news. one thing that I would say with this change is that if you're on a salary package, so if you're earning salary plus super, it'll be paid on top of your base salary. But if you're earning a salary package, which is inclusive of super, it's just something to be aware of, because if your salary doesn't increase at all, it could mean that you have slightly less take-home pay as a result. So if we look at the example I just used, if you're on a salary package of $100,000 inclusive of super, that means last year you would have had $10,000 of that package redistributed to your super fund, and your take-home pay before tax would have been $90K. This year, package stays the same, but a bit more of the pie will be sent to your super fund, so $10,500, which means your take-home pay would be $89,500, so slightly reduced. So it's just something to be aware of. I know anecdotally, speaking to some friends that are on salary packages, that their employer is adjusting that package, so their take-home pay isn't affected at all. So yeah, something to be aware of if you're in a package, just to look at that and maybe chat to your employer.
Yeah, and I guess that's, people will probably know if that affects them. If it doesn't, have a chat to your employer or your HR department, and I'm sure they'll be able to straighten that out anyway.
Yes, definitely.
On that note, actually, is there anything that most people need to do?
Nope, nothing at all. So it's all done for you, which is great. Your employer manages it. It's effective from the 1st of July, so it's effective now. So your next super payment, employers generally pay you super 4 times a year, so once a quarter. So yeah, you'll start to notice already in the next time you get a super payment from your employer that it'll already be factored in. So nothing more for you to do. And it's also worth noting that this is the increase to what your employer is required to pay you, but you can still add more on top of that if you choose to. This is just the required amount that your employer needs to pay.
Yeah. Now, generally speaking, broadly, when it comes to superannuation is, I don't know the stats off the top of my head, but I believe the leading way that Australians invest in the share market or another sort of sectors. Does the current market conditions affect the way that we should think about our super? Obviously that's a broad question, but broadly speaking, does a downturn mean that we should be reviewing our balances and our investment portfolios?
Yeah, can I take this one? I have something to say about this too. Go, Alison.
Okay, so it's definitely a very valid question at the moment. We're seeing a lot of people ask this question of us on the site. Lots of friends and family are asking me the same thing. People are aware that the market is taking a bit of a downturn at the moment. Shares are down, property prices are down a little bit as well. So people are worried about their super and thinking, what should I do about that? Generally speaking, for most people, if you're in a diversified fund, which most people are, the answer is typically no. You shouldn't be too worried. You shouldn't be running in and changing your investment strategy based on short-term market moves like this. So as an example, most people are invested in a growth fund or a balanced fund that invests in shares, usually quite heavily, but also other assets as well. So it'll also have defensive assets in there, like cash, fixed interest bonds, that kind of thing. So while one market is going down, others might not be or might even be going up. If you try to time the market as it's, as you'd be doing, and move your money out of super at the moment, there's a few reasons why this probably isn't a good idea. One being that the market is already falling. So if you wait for share prices to fall and then say, I'm going to move my super out of shares into cash, all you're doing is locking in that loss, which is kind of what Nicole said before about property. It's just on paper at the moment. So you're going to be locking that in and selling at a loss. So that's one risk. The other risk is that you stay invested in cash and miss out on the potential rebound when shares do recover, which they absolutely will. If we look at the share market fall that we saw 2 years ago at the start of COVID, the market fell a lot more dramatically than it has at the moment. So I think it fell about 30% in a matter of weeks, very quickly. A lot of people freaked out and switched their super out of shares into cash. But then we saw what was a very quick V-shaped recovery. So shares recovered very quickly and shot back up to their pre-pandemic levels. And a lot of people that had switched their super not only sold at a loss, but they missed out on that rebound and bought in higher when they switched it back. So there's a few things to be aware of there. But generally speaking, most people should leave their super as it is and let that play out.
Nicole, you were saying something. You had a point.
Yeah, it will exactly, Alison. And it's a really dangerous thing to cash out of investments when markets have fallen. It's scary and it's uncomfortable. And again, one of the best things to do is to not pay attention. Is to take a step back and go, okay, is my asset allocation is what it's called, which is the split between the assets, how your money is shared between them all. Is it right for me, for my risk appetite, and for my age? And that doesn't really change based on what's happening in the market, or it shouldn't. Having said that, I mean, cashing out, incredibly dangerous, exactly like Alison just said. But right now, for me, shares are on sale. So for me, I'm looking at that and going, oh, I mean, we wouldn't walk past a 40% off sale if there was something there that we wanted. Do you know what I mean? We'd do a double take. That's what this is like for me right now. So as opposed to selling out, I'm actually putting extra money into my super right now. And that's been my concerted strategy for a long time.
And I guess the only caveat to that may be just the fact that there are some talk of redundancies, and there have been some people who don't have regular employment. But if you're lucky enough to still be making a paycheck, then yeah, now is a great time to invest more. Nicole, is that a fair assessment?
Yeah, absolutely. And just again, another caveat is that with superannuation, your money is locked away until 60, of course. So you need to be able to lock away that money. That is really key as well. So you don't do it with money that you're going to need to access, for emergencies, possibly. You don't do it with money that you're going to need to access for a house deposit or for anything that's going to be shorter term. But for money that you really can tuck away for your retirement, then it could be a really valuable place to house it right now. Because don't forget, super is the most tax advantage structure that we have, the vehicle that is the best in terms of taxation for investing.
And I should mention as well, we did get a question through our early questions that we asked. Generally speaking, if you wanted to submit questions to us today that directly asked that question, should I be cashing out now with the market down? Hopefully we've answered that, but I think it's a good opportunity to mention to you, as you're watching this, if you'd like to ask a specific question, perhaps something not about your personal finances, but about something specific that you're worried about, please do it in the Facebook chat for this video. If you happen to be watching on YouTube, just jump over to the Facebook page, pop that question in, and we are going to be giving away $20 of Finder credit to 5 of our our 5 favorite questions or comments. So please do that now so that we have access to that towards the end of this session, where we'll get through those questions. Let's pivot now, though.
Sorry, I just wanted to add one more thing on the super thing, because I know that we've had a few questions on this. Another thing to add is that super is a really long-term play, so you shouldn't be too distracted on short-term market movements, because they're actually expected to happen. And just to give people some context on this, because I know that it can be a bit scary when you see markets go down and people don't seem to care as much when they go up. But just to give some context, so super funds are expected to deliver a slightly negative return this year, but that's on the back of last year when they delivered record returns of about 18%. So it's really good to look at, instead of 1-year returns, look at 10-year returns or higher, because that's going to give you a more accurate understanding of how super funds have performed. And they've performed really, really well.
Yeah, totally. All right. Here's one thing that is going to affect people short term, and it's the price of energy. Of course, we've seen a fair bit of news about energy and the energy markets over the last couple of months, and that has to do with both gas and electricity prices in Australia. There are lots of reasons for this. Maybe Sarah can go into a little bit more information, because on July 1, there were actually some specific changes that are going to change the amount that we pay per kilowatt. Sarah, do you want to give us an understanding of what those price hikes are for and about?
Yeah, absolutely. This is it's grim news because no one's going to escape this one, unfortunately. I feel like kind of like Nicole was saying before, every new financial year I'm finance journalist, so I get really excited about the changes. This year they haven't all been positive, and energy is one of those big ones that really took a lot of people by surprise. And so, like you said, there's a lot of reasons why wholesale prices have gone up. The Ukraine and everything happening globally has had an impact on supply. Our usage and kind of demand for energy has gone up as well. there's a lot of reasons why it's going up, but the bottom line is that prices are increasing. So people won't have noticed this yet on their bills because these increases happened as of the 1st of July, and energy bills are usually monthly or quarterly. So it's your next bill that you're likely to get a bit of bill shock on. And especially it's kind of, if you're in one of the southern states and you're using a heater. I'm in Queensland, we don't use heaters as much up here. But for the southern states, when you're using a heater, you're going to really notice those bills go up. And depending on where you live, there's different regulations that apply. And it's so confusing. It's literally the case that if you live in, say, Melbourne, the tariffs that you pay in the Melbourne CBD will be different to the tariffs that someone pays 40 kilometres away, who might still be considered a Melbourne city resident, but that is outer suburbs and that's on a different tariff and it's charged differently. So it is really, really hard to wrap your head around. And at Finder, we have some really deeply experienced experts who kind of work in this every day and try to write as many useful guides and stay up to date on all the latest information here, because it is changing so fast. And so what you really need to know is that bills are going up. Depending on where you live, it'll be anything from 5 to 18%. That's the regulated kind of increase that has been allowed. But the prices could actually be more than that, because these energy retailers can charge lots and lots of different plans, and they can charge more than that if they want. There was also the case this year where some smaller retailers couldn't absorb these growing costs, so they've increased their prices by 100%, which is really difficult to wrap your head around. So that means your bill is going to double, and it's confusing to know how you're impacted. But the good thing, or that the transparent part of this, is that these price rises have now happened as of the 1st of July. Some retailers, I think it's one of the big ones, either AGL or Origin, has pushed theirs back to the 1st of August. But the bottom line is it's going up. So for anyone that has an energy bill, which is everyone pretty much, what you can do about it is look at your current bill, see what you're paying, and see if you can get a better deal out there, and also really look at your energy usage. So, your big energy suckers are things like dryers and heaters, hot water. Look at how you use them, and whether you can use them more at off-peak if you have that in your plan, and just kind of throwing more blankets on instead of the heater. We literally were trading tips around the office a couple of weeks ago, and someone threw up the idea of double socks, and it's actually a game changer. I highly recommend it.
The amount of people who've been posting their hoodie, like the...
Yes, I was going to say also onesies with a hood.
Yeah.
Hot water bottles under the onesies. You'll never need a heater.
Yeah, I mean, it's something that is impacting everyone. And I live in Queensland, where our bills get really high over summer because we crank the aircon. Winter is my cheap bills. I think when you're down south, it can be a little bit the opposite. But my energy usage isn't something I've paid a lot of attention to, because our bill was relatively manageable. Now I'll be, timing the kids' showers and, just being a little bit more mindful of it, because, these bills at an 18% increase is really difficult at a time when everything else is going up as well. So yeah, it really pays to check into what you're using.
I remember in the days of fluorescent light bulbs where Dad would be absolutely meticulous when it came down to turning off the lights. And as soon as fluorescence came in, I'm like, Dad, they're 10 times more efficient. It's fine. There's nothing to worry about. As you say, I remember trying to wrap my head around the way the market works. And if you want to find out more about why prices are going up, the difference between the wholesale market versus the retail market, jump onto finder.com.au and maybe read a bit more, because it is there is a wealth of knowledge there, and it is not a simple thing to be able to answer. But as Sarah says, at the end of the day, it's about trying to find the best deal for you in your area, and just try and save money where you can by pulling your electricity use down. While we're talking about the home, I want to pivot to something that, at least for maybe 50% or so of Australians, is probably going to be the most important part of this particular time of year, and that comes off the back of the Reserve Bank increasing the overnight cash rate earlier this week. Nicole Pedersen-McKinnon, you literally wrote the book on being mortgage-free, but just this week you've written a column about your brand new mortgage, so congratulations. As a returning borrower though, what are you thinking about with the home loan market at the moment? What's the situation?
Yeah, look, it's really interesting because the climate into which I'm mortgaging is very different from last time around. So I'm never generally a fan of fixed rates, which is just, I should say that up front and be clear about that. And fixed rates have gone dramatically higher in anticipation of these dramatic interest rate increases. Having said that, I am going to fix some of my mortgage because all the best money theory in the world, all the fanciest forecasts on what's going to earn you more, etc. What you need to be when it comes to your money is bottom line, relaxed and comfortable. And in my situation now, I need my mortgage repayments to be contained to a certain extent. So fixed rates are higher. Yes, variable rates may still go above them, and we don't know where they're going to go. Without wanting to be scary, we don't know where they're going to go. So I'm still looking at a situation where I'm going to fix half. Now, I say half, and I would never fix much more than that because variable rates have some really key advantages in terms of debt reduction. So one of those is your ability to pay extra, which a lot of fixed rates don't have. Better still, though, they are the ones that come with full or 100% offset accounts if you buy that particular kind of product. Now, an offset account is actually a better strategy than repaying money directly into your mortgage. So you park money alongside your mortgage in an offset account instead of in it, as I say. And that means that you kind of quarantine that money from the mortgage itself. So I don't know if you guys remember at the beginning of I won't name and shame, but at the beginning of the pandemic kind of meltdown, the pandemic panic, there was a lender that recalculated the balances of its mortgagees and what they owed. And they actually sucked up a lot of the money that they'd sat in redraw, thinking possibly they were getting ahead, or possibly they were just parking money in there that was actually earmarked for something else. It might have been their emergency cash stash. It might have been their kids' school fees, might have been a holiday, which was obviously on hold at that point anyway. Anyway, that money kind of disappeared. So yes, they owed less, but the access to that money disappeared. And for a lot of people, that was exactly the opposite of what they'd been intending. So an offset account quarantines that money. Has another advantage as well, without getting too technical, your loan balance is never technically paid down. So it doesn't get on the ATO's radar in a way. So if you fill up an offset account, right, and sort of you pay off your property that way instead of directly into the loan, if you decide to later move, you can get that money out of the offset account, use it as the deposit for your next loan, and you can turn this one into a tax-effective investment property because you've never technically reduced that balance. So it just gives you the ultimate kind of flexibility, freedom, and safety to have that money in an offset account. It also means you can use every dollar that you've got to your name twice. So you can park everything you've got in there and use that to reduce your loan interest. If you're super savvy and disciplined, I would put in there away as well because it's extremely important. You could also use a credit card all month for your expenses and only pay that bill out of the offset account because you can then sit your salary in your offset account, only pay that bill when it's due. So it's a way of also using the bank's money for free to get you out of debt earlier in terms of your mortgage. So yeah, as I say, 50-50 is my strategy now. And I'm happy to pay a little extra on the fixed rate in the hope that maybe I'm doing the right thing and I can still really hit it hard on the variable portion.
And I guess this is probably going to be an over-reduction, but part of the reason, tell me if I'm right about this, part of the reason you sometimes recommend against fixed rates is because the fixed rate has already kind of factored in future rate rises into the actual amount, and all the actuaries and like the wonks in the bank have already done that, right?
Oh, 100%. Like when you fix a rate, you are betting against a whole bunch of very clued up boffins who are crunching the numbers and, forecasting out what's going to happen with interest rates. Like anyone can get it wrong. Absolutely. But the time to fix is before rates are rising, and there's talk of rates rising. So fixed rates have gone up dramatically. So last week we saw CBA implement this unprecedented 1.4% hike in its fixed rates across the board. NAB followed swiftly with 1.1%. Those kind of movements have never been seen before. Having said that, just having that half portion that is not going to increase gives you a bit of an anchor for the rest that may still go a bit higher.
Sure. So there was a pre-submitted question that we did get, which reads, I've got a very expensive Melbourne mortgage. Have I left it too late to get a fixed rate home loan? What would be a quick answer to that?
Oh, quick answer. If it's going to make you more relaxed and comfortable, you could consider fixing half. It would very much depend on your personal circumstances, but definitely weigh up everything I've just said about the ability to pay down the variable portion quicker.
Yeah.
I would also just add really quickly into that to be mindful that if you do fix anything, you're going to pay more now. So fixed rates right now are quite a bit more than variable. So your payments are going to increase immediately, but it can be worthwhile if that peace of mind, exactly what Nicole was saying, peace of mind of knowing you've kind of capped it can be worth a lot depending on how much you've got in your debt.
Yeah.
Something about a bird in the hand and two in the bush.
Yeah.
Red rise in the hand and one in the bank. Thanks for getting stuck into that. And I wanted to just make one more appeal. If anyone does want to raise their own question about something specific we talk about, not your personal finances, but a specific area, please jump in the Facebook comments. All right, let's move on quickly to our last sort of planned segment, because inflation has been sort of the new word. It might be the word of the year, I think, if there isn't some other sort of meme that jumps around and beats it to the punch at the end of 2022. Inflation, of course, in the US and the UK sort of leapfrogged us a little bit, and we have been a little bit behind it, but just recently we had that sort of 5.1% inflation figure that shocked a lot of people. Phil Lowe, the chair of the Reserve Bank, has said that by the end of the year, it could get up to 7%. This is the general cost of prices going up. Alison Banney, I guess the quick question would be how can we beat inflation? But I imagine it's a little bit more complex than that.
Yeah, unfortunately, there's not one easy way to beat inflation. I wish there was. As you said, yeah, things are getting more expensive, as I'm sure we can all tell. Groceries are going up. There's been heaps of pictures online of iceberg lettuce selling for $10 or more.
It's broccoli
crazy
for me, Alison.
Yeah.
I adore broccoli, and $12 a kilo is too much.
I know, and I did see that people were starting to rip the bottoms off broccoli so that weighs a bit less. So yeah, people are doing all sorts of things to beat inflation. But
at a point, it does become stealing, though, doesn't it? I mean, yeah, you can take the stalks off mushrooms as well, but how far are you willing to go for stinged thread?
That's what it was online.
Broccoli stalks are delicious.
I eat the stalks as well. I think there's been a misconception here that you can't eat the stalks, but anyway, that's neither here nor there. So as you said, inflation's up 5.10%. This has been big news this year. It's probably, you've heard about it more this year than any other year because it's the biggest jump that we've seen in about 2 decades. So it's really noteworthy, and it's only going to get higher for the rest of the year. So a few things that you can do here. The main two are you want to increase your income and also decrease your expenses, or bring in more money, or reduce the money that's going out. So that's easier said than done. To bring more money in, the first thing to do is if you can get a pay rise or increase your income that way, that would be great. I understand it's not as easy as just, knocking on your manager's door and demanding a pay rise. It doesn't really work like that for a lot of people.
Let's not forget there is that increase to the minimum wage, which is very welcome as well,
yes,
which
very welcome.
Slightly exceeds inflation too. It just gets people on that minimum wage, the lowest paid workers, up to speed, but it is something.
Yes, absolutely. No, that's a very good point to raise. If you're not on minimum wage, you're in an award and you're negotiating your own pay, it could be something to raise your employer this year. If you've got an annual review coming up, it's good to keep in mind. Other ways that you can bring in more money, you can consider a side hustle, sell things online. I recently, over the weekend, it was raining here, so I went through all my wardrobes, found a bunch of stuff that I don't use anymore, sold it online, made almost $200. So it's just a good way to think about how you can bring in some extra money at the moment, as well as looking at how you can cut back. So the first thing to do here is look at where your money is going at the moment. So it might seem a bit daunting, or you might not really want to know, but you really should sit down, have a look at your transactions for the last few months, look at just what you're spending money on. You might surprise yourself. You might think, I only go out to eat once a week or so, but you might look back at your transactions and realize, it's actually 2 times a week or more. So just being more aware of where your money is going, you're more likely to make conscious efforts to cut back and save in those areas. There's also things that you can do to sort of boost your income a little bit in terms of your products and services. So as Nicole mentioned before, home loan rates are going up. quite significantly, but so are savings rates. So if you've got money sitting in a bank account, not really doing much, raising rates for savings account is actually really good news for people with money in the bank, because it means that you're getting more interest. So if you have your money just sitting in a bank account, maybe consider putting it in a savings account instead, because some of those are paying 2 or even 3% interest on your money. Now, that's not quite the level of inflation, but it's much better than just sitting in a standard bank account doing nothing.
Totally. Are term deposits benefiting from that as well?
Yes, absolutely. Term deposit rates are going up as well. The one thing to know with term deposits is that they're locked in. So you can open a term deposit for anywhere between 1 month to 5 years, but you can't access your money in that time. So generally, term deposits will pay a higher interest rate for a longer term, because you have to say goodbye to your money for a longer period of time. So you might earn over 3% per annum on a 3, 4 or 5 year term deposit, and you might earn, say, 1.5% on something that's 12 months or less. It just depends if you're willing to go without your money for that period of time, then it could be worth looking at. They're fixed rates as well. So the thing to note with that is that they won't change for the duration of the term, similar to the home loan rates, if you're going to fix that in, which means that if rates do continue to go up, fixed rate, you won't benefit from that rate. So that's something to consider as well if you're looking at a longer term loan.
Thanks, Alison. And
Tim,
of course, yeah, go.
So on the issue of wages, if I could just circle back to that, wage-wise, you've got some bargaining power right now, because you've got an unemployment market that's not been this tight for nearly 50 years. So we've got an unemployment rate that's way down at 3.9%. So we've been talking a lot about the inflation rate of 5.1%. That's how much everything is going up in terms of what you have to outlay. The wages are only going up about half of that amount. So that's where this pain is coming from. But employers, the fact is, need you, because it's unlikely that they're going to be able to replace you. So if you actually go to your employer, with a calm, considered, reasoned, evidence-based pitch to get a pay rise that at least equals inflation, as opposed to maybe the 2.4% or nothing, then it's really good timing to do that right now. You have a very valid prospect, particularly if you can prove your contribution to the company's bottom line.
Or you could just slam your fist down and refuse until you get more money to work again.
You could go out in a blaze of glory and get another job, which is what a lot of people are doing, because of course that is the way of getting the big price hikes in terms of salary, is to actually go somewhere else.
Yeah, not that any of this is personal financial advice. I think there has been pretty good research.
Think carefully before slamming the door on your way out.
Yes, yeah. That is probably worth mentioning very quickly. We are going to jump into some questions, and we're going to try and get through as many as we possibly can. Just to reiterate, this is not personal financial advice. It's general in nature only, and if you do want to make some changes to your finance, we highly recommend that you go and get some professional help that considers your personal circumstances. Now, we did answer a few of our pre-submitted questions during the course of the main sort of masterclass, the main topic. So if we don't get around to your question specifically, I do apologize, but hopefully you've got an answer. I did see one though that we didn't get to, which is that, quote, "I heard energy prices are going up, so I told my partner to stop running the dryer as much." But of course, it's pouring with rain. This is a couple of days ago. So the dryer is kind of important. What's the best time of day to run the dryer? Sarah, do you have an answer for this one?
Yes, I do. And it depends. What a great answer. It depends on what kind of energy plan you're on. So there are broadly, I'm simplifying this right now, but there are broadly 2 different types of energy plans you can have. One is kind of a single rate. So that means you're paying the same rate no matter what time of day it is. And the other one will have time of use charges. So that means you usually pay a little bit more during peak times and you pay a little bit less during off-peak times. So if you're on one of those types of plans, it might be the case that, after 8 p.m. at night and before 7 o'clock in the morning, you have a cheaper rate, and that's when you should run your dryer. Also depends if you have solar, because if you have solar and it's a hot day, in the middle of the day when it's sunny is the time to do everything that sucks energy. But the great thing is all of these energy retailers have smart meters or kind of like apps and things that you can download too. So if you really want to go down the rabbit hole and look at your usage and make some like meaningful changes, you can get a meter that actually shows you in almost real time. I think it's in 30-second allotments. It shows you what energy you're using, which can be a really powerful way to see what you're using and figure out how to cut it back. It's one of those things, I think, when you actually see it and you see the meter ticking over. I know when I got solar for the first few months, I used to love going out there and looking at the energy tick back as solar was feeding into the system. It was amazing. That is another part of this whole landscape that is changing too. A lot of the, or some of the energy providers are now paying less for your solar rebates. So I know that my energy provider at the moment, I get 16 cents per kilowatt energy of the solar that I feed back into the system. A lot of retailers are changing that down to 1 cent, 5 cents, or sometimes nothing, because that's a whole other discussion. But we're feeding too much solar energy back into the grid that they can't really. We've got too much solar. So yeah, that was a really long-winded way of saying check your energy bill, see if you're on a fixed rate or a time of day use. If you're on a fixed rate, then kind of using the dryer whenever you want is not going to make a difference. It's just the fact that you're using the dryer that is going to cost you money.
Yeah. All right, let's get into a couple of questions around tax and super. And I might start with a basic question and then go to something a little bit more complex. One question we got might be a noob question, which is to say a question that I should already know the answer to, if you don't game. But could someone highlight the concept of the tax-free threshold? I got taxed a lot last year when I was working 2 jobs because I claimed the tax-free threshold on both jobs. Nicole, I assume you've got an answer for this?
Yeah, look, you should only claim the tax-free threshold on one job, because otherwise you're not paying enough tax is the bottom line. So as much as we all want to cut our tax, what's really important if you're an employee is that enough is reserved for you along the way so that you don't get, bill shock. We're talking a lot about bill shock in regards to other things, but you don't want that bill shock in terms of your tax bill either. So that's about having enough PAYG, or pay as you go, taken out of your pay by your employer. If you claim the tax-free threshold twice, then you're not going to have enough taken out. That's the issue. It does hurt on the second job, like it really hurts, but hopefully at the end of the year, it won't. Can I just add something there though? There's also this kind of incredible opportunity. You need to be really careful about it, but it is possible to vary what is withheld from your pay in terms of pay as you go. So what you do is you go to the ATO's website and you fill out a form called a withholding variation. Now, you only do this if you always get a tax refund, and if you're confident you're going to get a tax refund, you're on track for one again this year. And what you can do, we're talking about everything going up, the power, the dryer, etc. What you can do is get that refund in every single pay, rather than waiting a year and a half and letting the ATO sit on that money and pay no interest for it. You can get it in your each and every pay packet. So if you do typically overpay through PAYG, then perhaps it's time to look at withholding variation and get that to help the cost of living.
There you go. Some advanced tax hacks. I did not know that existed.
Yeah,
so
it's a really good one.
I have learned something new today. All right, let's switch over to superannuation. Alison, this question I think makes sense for you for a reason that I'll mention. Is it beneficial to salary sacrifice into your super at a younger age to pay the maximum limit allowed, or is it better to top up super post-tax pay? Now, I know you happened to write about this and you took a slightly contrarian approach, but generally speaking, what would be your advice on this particular question?
Yeah, so super, as I think Nicole mentioned earlier on, is one of the best tax incentives that we have in terms of investments. So the way it works is your money, if you send it to superannuation, is taxed within the super fund, and that's at a concessional rate of 15%, which for a lot of people is going to be lower than your income tax rate. So you're allowed to contribute up to $27,500 per year into your super that's taxed at that concessional rate of 15%. This includes the money that your employer sends you towards your super. So if you get rid of the money that your employer sends you, you can make up the difference and contribute that. Now, this is beneficial because that money that you send to your super fund will be taxed at that lower rate instead of your income tax rate. If you do this from your pre-tax income, that's called salary sacrifice. So the way it works is you tell your employer, I want to send this much money from my pay every pay cycle into my super instead of into my bank account. So because it's from your pre-tax income, that money will go straight into your super fund, taxed at 15%, and you won't be taxed on it with the rest of your income. So not only are you saving that that tax, but you're also reducing your taxable income at the end of the financial year. So that's a really good benefit of adding more money into your super. The question around should you do it when you're young? Again, it depends on what you're trying to achieve and your other financial situation. The article that you're referring to that I wrote last week is where I talked about the reasons why I don't personally contribute extra to my super at the moment. And the reason for that is that contributing extra to your super is great. It's the tax benefits that I just mentioned, and it's also going to help you retire with more money, because the earlier you do it, the more it's going to compound over time. But you can't access that money until you retire. So it's for your retirement. It's there. It's locked. You can't take it out, which is the way that super is designed. So the reason why I'm not personally doing it at the moment is because I'm using all the extra money that I have right now to fund a property. So if you're saving heavily for a first home, you might decide that instead of sending extra money to your super right now, you'd rather save that up and use it to get into your first home sooner. And then maybe once you've got into your first home, then you can consider adding extra into your super. As I said, you might decide that that's not the case for you. That's completely fine. But that's personally what I'm doing. So yeah, it's just good to remember that there are many benefits, but you can't access that money. So don't go put all your money in there if you want to use it.
Yeah, I think that the point you make is a really good example of why we can't provide personalized tax advice, because your situation is going to be very different to mine, to Alison's, to Nicole's, to Sarah's.
Yeah, absolutely,
to
yeah. You might not be wanting to buy a property, or you might already have one, or it might not be in your financial plan. So.
And look, mathematically, you can crunch the numbers, all other things being equal. It is advantageous to salary sacrifice into super rather than putting post-tax money towards a mortgage or, a deposit for a mortgage. Having said that, the thing that's going to give you the most level of comfort and financial security is a fully paid off roof over your head. So if that's the most important thing to you, then do that. Only you're going to be able to make that call.
Yeah. And at the end of the day, your lifestyle is probably the most important thing. Now, I would say, if you wanted to get, personal financial advice or tax advice, of course, you're going to need to pay for professional help. And a question has come through, which is, what is a decent price for an accountant? Now, I don't know. And so I'm very invested in this because I've never had one before. So, Sarah, do you happen to know off the top of your head how much accountants should charge?
Yes, I do. No, I don't actually. I don't know specifics, but I can give you some ballparks for sure. There is a huge variation here. Because there are some very, what would you call it, like cookie cutter, one size fits all solutions, that could be as little as $100 or $120, and they're going to give you a very fast and very basic service. Those types of services can be useful, but I have known people to use them before and they've missed out on big deductions, or they've actually gotten the wrong advice because it was quite a quick service, if that makes sense. It's kind of the more you invest, the better result you're going to be. If you were going to an accountant, you could be looking at paying kind of between $200 and $300. And then if you've got that's for a pretty basic tax return. And then if you've got some complex parts of it, if you've got investments, if you co-own a property with someone, and if there's extra things going on, you might be looking at $500 or more. As Alison said before, though, that fee that you pay is tax deductible. So it's going to come off your next year's tax return. And it really is a decision you need to make based on your own personal situation, because I know for myself, I have paid accountants before who have found things to do with depreciation or to do with things I didn't know to even ask that question. And then they've saved me thousands of dollars because if I was doing it myself, I wouldn't have even known how to do that. But that's rarely going to happen with a really regular salary. This is more like if you've got complex things going on. And again, the giant caveat of don't take this as personal advice because none of us are accountants. But I think it's something that if you are you're on a regular salary, you're wanting to claim some working from home deductions and, a couple of charity deductions, you can probably do that yourself. If you've got some more complicated things going on, or if you haven't done a tax return in a few years, that's a good time to go and get advice because they can catch you up on things. But you'll be looking at anywhere from kind of 120 at the lower end through to 300 for a regular tax return.
Cool. Nicole, I might ask you this question because it's sort of related to tax returns, but you might have the best experience here. Is it more likely that you'll get audited if you do your tax returns yourself versus an accountant, or is that kind of up in the air?
I think that's up in the air. I think there are some, red flags that kind of set you up for that kind of scrutiny. And just be aware that right now there are more of those red flags. There's some really kind of obvious ones. And that's because of this sort of pandemic economy, this coronavirus economy we've been in right now, where a lot of us haven't been able to work in a normal way. So we talked a lot about the kind of all-you-can-eat style of working from home deduction that is available until the June 30 cutoff. So not this year, but last tax year, last week, available for that one. We didn't talk about some other things that you might typically claim deductions for that might actually set off alarm bells in the ATO right now. For example, the 5,000 kilometre mileage kind of amount you can claim without too much evidence on that. Could you really have driven 5,000 kilometres in terms of a work commute and work to and fro last year? Just be careful about those kind of things, which just don't sort of fit your circumstances right now, given that there are some overarching kind of macro stuff happening that the ATO is going to be looking at quite closely.
Yeah, I don't own a car, so that would be very much a red flag for me.
So do not claim that. That is advice.
Okay, I will take it.
Nothing else is advice. That is advice.
The advice not to act is a bit safer than the advice to act, I guess.
The important thing there, sorry to just jump over you, Tim, but the important thing there to note is that even if an accountant does your tax return, you are signing off on it saying, I provided all this information and I'm saying it's true and correct. So even if you do get audited and you're the one who is ultimately responsible for it. So don't go crazy. Every year, the ATO has, like Nicole was saying, they have specific red flags that they're looking for. And if your return ticks a lot of those boxes, you're more likely to end up in that audit basket.
Yeah. All right. Look, there's one last question that I want to do a very quick answer to before we maybe do a 30-second roundup and get our last thoughts before the hour. The question was, where would you recommend finding information about completing a tax return if you have crypto in your portfolio? I did a bit of a deep dive on this fairly recently. The actual answer is probably to start with the ATO. They've actually got some really good guides and advice. Start there and then maybe talk to a tax accountant. I would say holding crypto at the moment is very much one of those boxes of I have a more complex financial situation at the moment. So perhaps get some professional advice. Now, with that, we are very close to time. So I'm going to do a quick 30-second roundup. Alison, I'll start with you. Is there anything that we very quickly haven't covered, or do you have like a last couple of words before we wrap up?
I think we've covered a lot of ground today. I think my main closing statement would be to really be aware. At the moment, we know things are getting expensive, as we said. So I think the best way to combat that is just to be aware of what your money is doing. Be aware of what's coming in, what's going out, and where it's going, because that's going to help you save more money. You'll be able to see where you have capacity to save. So I think, taking an active interest in your finances is a really good first step to being financially savvy. So if everyone that's showing up today, well done.
Yeah. Sarah, do you want to jump in, and I'll leave Nicole to last? Or do you have any last thoughts?
Absolutely. And I am just doubling down on what Alison said, but also what I would say is look at all of your bills as a bit of a starting offer right now. And what I mean by that is we tend to just pay bills and set and forget. You get your electricity bill and you just pay it, or your insurance, or whatever it might be. And you just kind of accept that that's the price it is. I would recommend everyone set aside a couple of hours and, with a cup of tea or coffee, and just actually start comparing and make sure that you're not paying too much. I personally shopped around for my house insurance last week because I got a renewal. So the renewal prompted me, but don't wait for the renewal to prompt you. Just go out and do it now anyway. Because when I did, I realized I've been overpaying by so much. And the renewal price actually got something $1,400 cheaper. Which is just such a significant saving. So if you have car insurance, health insurance, home insurance, your energy bills, any of those things that you can compare and see if you can get a better deal, now is the time to shop around and start locking in some better options.
And a casual plug, of course, for finder.com.au, which has a huge range of tools that allow you to do that very quickly and simply. Nicole, thank you very much for being our special guest, of course, but what are your last words on the thought on this time of year?
Look, it's never been more vital to finesse your finances. Right now is the time. You know, we've talked about cost of living craziness. We've talked about the difficulties in wages keeping pace with that, although don't miss that as an employee, you have some great bargaining power right now. What we probably haven't talked about enough is the fact that the one lever to pull is probably the main pain point in your hip pocket right now, which is that mortgage. So if you're on a variable rate, the rate officially for the average across the market is 4.65%. You can do way, way better than that. The best quality rate, even post the rises that we've seen, is way down at 3.1-ish%. So that's your benchmark right now. So on Finder's own figures, on the average Australian mortgage, which is about $611,000. So the rises that the RBA has applied so far have upped the monthly repayment by $424. That's huge. That's scary. That's sudden, like we've been saying. However, if you refinance from that average mortgage to the best quality product around that 3.1% benchmark, you actually save $541 a month. So you can entirely cancel out what the RBA has done so far. So if you do just one thing, pull that lever and, you know, alleviate the hip pocket pain to date.
It's awesome. There's so much to be made of just a little bit of, as you say, finessing your finances.
Absolutely. Yeah.
Well, look, first of all, I want to say a massive thank you to all of our panelists, Alison Banney, our money editor, Sarah Megginson, our head of editorial, and of course, our special guest, independent finance journalist, Nicole Pedersen-McKinnon. Thank you all so much for being here. Collective round of applause.
Thank you so much for having me.
My name's Tim Bennett, and thank you for spending some time with us today to lunch and learn with us. Hopefully you enjoyed whatever you were eating. We hope some of your burning financial questions have been answered. If you have any additional questions, head over to Instagram at finder.au. We'll answer more questions there. We're always, we're fairly active. We've got a great social team here, and they connect with us and the other experts in the building who, can help you get the best out of your money. And don't forget to make the most of your money generally at Finder. We help everyday Aussies save and grow their money literally every day. If you're not using the Finder app, we'll share a link in the event. We'll share a link possibly in an email or on the Facebook page. We'll do it there. Thank you again so much. Thank you again to all our guests. Thank you again to everyone who helped make this possible. Kiki, Emily, Joel, and the whole team at Finder. See you next time.